Hi there guys, hope you guys are well. Welcome back to my channel. So guys, I just want to ask you, I don't know about you, but I just find, the lower time frames lately are just I'm really battling on the lower time frames to actually make profits, and my account growth is just going sideways. It might be the algorithms now, times are progressing, so the market maker algorithms might be improving, but I just find that the lower time frames are just almost like lying to you. The setups are not working out, the candlesticks, pin bars, engulfing candles just mean nothing nowadays, and everything just doesn't work out. So what I've been doing now is, as I explained in the last video, I've migrated to the higher time frames such as the H4 and the daily. Last week I took a setup on AUD USD based off the daily and the H4, and then only using the lower time frame to actually refine the entry and enter. So I just want to show you guys, if you're struggling with your trading on the lower time frames, just by migrating up to the higher time frames, how there's so many benefits to it. You'll be trading less, the setups will be a lot more high probability, the candlesticks won't lie to you, they'll actually speak truth to you, because it's difficult for the market makers to lie to you on the higher time frames. You can also see the trend and you can see the flow of the market better on the higher time frames. And I actually traded with really low risk, and I made literally like a 12% gain on my account. So the key takeaway here is to migrate to the higher time frames and to actually trade with lower risk, because the candles are a little bit bigger and all that. You need to actually chop your risk. So for example, if you trade normally at a 1 lot, you'll need to actually trade now at a 0.3 lots. So chop it up, divide it by 3. But because you'll be catching more pips on the higher time frames now, your gains will be a lot more. I promise you guys, from next week, give it a try yourself. Try take a setup based on the actual strategy that I'm going to show you that I'm using now, and I guarantee you'll start seeing success going into the end of this year, and you'll have a completely different outlook on the markets next year. So trading on the higher time frames with lower risk, that's the whole point of this video, and how to get sniper entries on the H4. I'll catch you guys inside. Just want to walk you over this trade setup that I took on Thursday at the end of the New York session. I just want to break it down quickly with you guys and show you how simple this strategy is. It's just simple market structure, just a few small basic elements that you need to understand. This was like a 1 to 5 risk to reward. As I said to you guys, I'm migrating more towards the higher time frames. So I'm looking more at the 4-hour patterns, 4-hour candlesticks, and then getting my entry on the lower time frame, such as the 15-minute. But the 15 minutes only used for the entry. It's only used for the entry. I'm not looking at 15-minute structure or anything like that. I'm actually just using the 15-minute to enter. But it's all based on the 4-hour setup. So if you look at the setup over here, basically what I saw was this big rejection candle over here. So you see this bearish hammer. Because what I'm doing now is I just don't trust the lower time frames anymore. I don't trust the patterns. I don't trust the candlesticks. I believe that the lower time frames actually lie to you. But it's very difficult for the market makers to actually lie to you on the higher time frames. So if you look at this, just looking at this candlestick, you can see over here the big wick. So this is a big bearish hammer right over here. If you just look closely at the 4-hour, how nicely the market respects these 4-hour candlesticks. Here's another bearish hammer right over here, and look how the market dropped. If you just look at candlesticks with long wicks, you can just see how the market just respects these 4-hour candlesticks. If I keep going, you'll see that what I'm looking for are these big rejections, so long wicks, at the bottom or at the end of trends or during a trend, to actually either get back in a trend or to catch that reversal coming down. So in this case, it was a reversal. But you can just see here how nicely these 4-hour candles get respected, especially the candles with long wicks. If I keep going, I'll just show you even the bearish engulfings and those sort of things. You can see a bearish engulfing candle here. You can see how nicely the market respects those candlesticks here. You see a tweezer bottom, right at the bottom of this trend, and see how the market, so just the 4-hour candlesticks are just way more respected. I'm also looking at the daily for structure and those sort of things, but I'm basing my entry off of the 4 hour. So the main reason for this entry over here was, let me just remove these quick. Okay, so the main reason for this entry was, you can see that the market is pushing up. You know, it was pushing up, but you can also see that it's starting to slow down quite a bit. You can see over here it's starting to not really push up, and it was starting to slow down. You can see also by this little drop over here. Alright, so just by looking at that, well, I'll take that off. So I saw that the market was starting to slow down. So what we can also see is that this liquidity over here got taken out. Alright, so the market took out all this liquidity from this push over here. Okay, so after they took out this liquidity, I saw this big pin bar with this huge rejection wick. Okay, and then I started to get interested after that. So basically, number one, you know, liquidity has been grabbed, and the second thing is the actual price action. So we can actually see this big rejection bearish hammer. The next thing I also look for, I noticed looking left, is that the market's really struggling to, if we put a line across here, let me just remove that. If we just put a simple line across here, we can see that the market itself is really struggling to break this area over here. Alright, we can also see over here the market failed to break this area. So this area is acting almost like a brick wall. Alright, so we can see the market has also come back to this area. So this is like a typical break and retest setup. So you can see over here, this is like a, if you want to refer it to as a V, and what's happened is the market is pushed down. Now it's coming back to retest. It's come back to retest this area. It's battling to break this brick wall before now wanting to push down. Alright, so if we just move that across. So it's basically a typical break and retest of a horizontal level. Okay, so so those were the main three reasons for actually entering the trade. We also add a round number, so we also add a typical round number, which is 68,900. It's 68,900. So what I did was I dropped down to the 15-minute time frame. Let me just remove this quickly. So this over here was basically that bearish. If we go to the 4 hour, you'll see this was that bearish hammer right over there. So I dropped down to the 15-minute time frame, and I didn't enter exactly there. I waited for the next day. I waited for a retracement. So what you want to do is you want to get in. You don't want to enter straight after that candle closes. What you want to do is wait for a retracement. So I drew a fib from the high of that to the low. So the market pushed down, and then it started to climb up. So I drew a fib from the high to the low. And what you want to do is, the reason why you want to do this is because you want to enter at a premium or at a discount. And then what I did was I waited for the price to come, and I saw it respecting the 78.6 fib. So then what happened is, later in, I was going to enter here, but there was news, I think, and stuff like that. So I waited. Well, I think the news was here. I didn't want to trade during news. So after the news, I saw this bearish engulfing candle, and I waited for a slight pullback on that bearish engulfing candle, and then I got in there. And basically that was the actual reasoning for the trade entry. So you want to, after you see that candle, that rejection candle, you want to wait for a few 4 hour candles to play out. You want to wait for a retracement back towards that inside of that 4 hour candle. So you want to wait till the actual market retraces back. Okay, I'd also seen the second 4 hour rejection over here. Okay, another example of that would be, let's just look for another example over here. Here we see a big push up, right? Here we see a big push up, and we see the market comes back down, right? So what you want to do is, In this case, for example, you want to go from the swing low to the swing high, like this, and you want to wait for a retracement. So you can see the 78.6. I like the 78.6 because that's normally the deepest retracement. So after you get a big rejection at a certain level, if we zoom further out here, we can maybe see if this was rejecting some sort of level looking left. You can see it was bouncing off this order block over here, right? Another reason for taking this trade on the top here is that if you look on the 4 hour, all the 4 hour imbalance got taken out. So you can see over here there's a major imbalance on this candle. And you can see it came up and took out all the imbalance. So that was actually the fourth reason. So it's basically your candlestick patterns, market structure, and then looking for a discount entry to actually catch the move. If you wanna look for a trend continuation, so for example, if we can see the market's pushing up, what you wanna then do is basically just if you wanna join in on the trend, what you wanna do is, say now we wanted to get in somewhere around here, we see the market is rejecting, so you want to draw a fib from the swing low to the swing high and then wait for a retracement. See how the 78.6, there was a major rejection off the 78.6, and then there was a bit of a pullback. So during that pullback you want to enter on the lower time frames once you see the rejection. So the stop loss for this trade here at the top was, so a lot of people say that I need to start showing where my stop loss and stuff goes. So I entered here at 68.70, so right over there, and I had my stop about 55 pips. I'm not trading with a very overly tight stop, something like that, and I caught, that was a bit, I think it was a 45 pip stop, somewhere around there, and it was like basically a 1 to 4.5, 1 to 5, somewhere around there, right? Because a lot of people, the mistake a lot of traders make is that they'll enter after the candle closes, and then they'll have their stop above, like that for example, and they'll be targeting down here. But the reason why you want to wait for the retracement is because you see the difference now in the stop loss. And the risk to reward's a lot greater if you wait for that retracement. So don't ever enter as soon as the candle closes like that. You want to actually wait for a retracement so that you can have your stop losses actually. So in case the market wants to jab a little bit into your, just above your entry and then reverse, so it's safer to a lot better. It increases your risk to reward. Yeah guys, that's why I'm migrating to the higher time frames with very low risk. So I'm entering with really small positions on the lower time frames. And even this trade here gave me like a 12 to 15%, I think it was 13.5% I got basically with a really small position on this trade. It was basically about 200 pips. And I'm still holding about a third of a position on this, which is the position that I've left for a runner. Okay guys, hope this video helped. Catch you guys in the next one. Please guys, migrate to the higher time frame. Stop trading in the noise. The lower time frames are lying to you. Trade on the higher time frames and you're with low risk. So obviously if you're on the higher time frames, you want to drop your lot size a bit. So if you're trading normally with a standard lot on the lower time frames and the higher time frames, what you want to do is split up your risk into 3 or so. So trade with a 0.3 lot in the higher time frames to split up your risk. So if you're wrong, you can also stack a few more positions, 20 or 30 pips as the price goes against you, and then all of those trades will most likely go in your favor, but you're still risking the same amount. So I'm trading less and I'm trading on the higher time frame. So I'm only looking for one setup a week or maybe two, depending. Have a good week guys. Hope this helped. Take care.